When that happens, when the housing market starts to slow because the Federal Reserve has raised interest rates, there's this ripple effect across the economy. And then eventually the foot traffic slows down in all these stores and they have to let people go.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Daryl Lyons.
Hey, this is Daryl Lyons, CEO and co-founder of Pax Financial Group, and you're listening to Retire in Texas. This information is general in nature only. It's not intended to provide specific tax, investment, or legal advice. Visit paxfinancialgroup.com for more information. So today I want to talk about a soft landing. This is actually the number one buzz phrase on Wall Street and has been since the beginning of the year, soft landing. And I asked a few people that aren't in the financial world, have you heard of this phrase? And a lot of people are like, no, I don't even know what you're talking about. And in the financial world, it's a huge, huge buzzword. So I need to take that financial jargon and make sure you understand why it's being talked about so much in the marketplace. And so that's what we're going to talk about. And before I get started relative to soft landing, I do want to tell you about an airline, or I guess a plane ride I was on recently. Coming back from Cleveland, I was at the NFL Hall of Fame. I have a couple friends on the board. And since I was a kid, I've always loved the NFL. And it's just fun for me. I can't really describe it, but just enjoy the NFL. So I was at the NFL Hall of Fame, flying back from Cleveland. Hall is in Canton, but I was in Cleveland. And as it landed in San Antonio, it was very bumpy landing. And the stewardess said, I'm really, really sorry about that landing. Just so you know, it's not my fault. And then she said, and just so you know, it's not the pilot's fault. And then she paused and she said, it's the asphalt. And everyone just started laughing and no one really cared about the bumpy landing. And it was funny. Southwest, sometimes you just get these stewardess that are just hilarious. And I got one. It was fun. So there's your joke of the day. And it really leads into this soft landing conversation versus hard landing. A hard landing, I think if economists were talking about hard landing, they're talking about a recession. And where are they landing from? Well, the idea is that the Federal Reserve has been raising interest rates. And they've been raising it aggressively. And why are they raising interest rates? They're raising interest rates because inflation was at 9.1%. And if inflation continues at that rate, the economy can't function. So they have to fight inflation by raising interest rates, and that slows down the economy. The interest rates were at 9.1% at its peak. And the Federal Reserve has said, we want to get inflation down to 2%. So how does this idea of raising interest rates slow down the economy? Now, I think you know, but let me make sure that it's clear in the flow of logic. There's several different ways, but let's talk about home purchases for a second, because you can see this happening right before your eyes. As interest rates go up, it is more challenging to buy a house. You can logically think about it. If you have a 2.85% rate on your mortgage, and now interest rates on mortgages are 7%, you're not likely going to move. And so less mortgage activity, less home buying, less moving or upgrading homes is disruptive to our entire system. Because what do you do when you buy a home? Not only does that help the housing market, but when you buy a home, you walk into a room in your kid's bedroom and you go, you know what? I want a different color paint. So you go to Home Depot and you buy paint, or Sherwin-Williams and you buy paint. What if you want to hang some pictures and you need nails? So you go to Lowe's, Home Depot. Or you want a new table because your kitchen table doesn't really quite work in this new kitchen. You go to Ashley Furniture or wherever. But when homes aren't being bought and sold, then consumers aren't going to these stores and buying these little things that make these companies profitable, like Home Depot and Lowe's and Walmart and you name it. There's so many different companies attached to the homeowners market. So when that happens, when the housing market starts to slow because the Federal Reserve has raised interest rates, there's this ripple effect across the economy. And then eventually the foot traffic slows down in all these stores and they have to let people go because they just don't have enough business. So the question is, here's where we get to the soft landing. Every economist knows that it's going to slow. That's how this game works. The Federal Reserve has raised rates. The economy is going to slow. That's not a surprise to anybody. The question is, to what degree will it slow? So some people think it's going to slow down to the degree that Home Depot, as an example, will maybe let a couple people go, but it's not that big a deal. Like, okay, we can work through this. Our earnings, and they're kind of down right now, but not too bad. By the way, I watch these earnings all the time. I mean, I can't say that I see every single one, but the earnings right now are not terribly bad. But they're starting to slow a little bit. They call it same store sales, comp sales sometimes. But they're starting to slow a little bit. And so if they just slow a little bit and a few layoffs happen here and there, then that's called a soft landing. But if they're laying off a ton of people and they're laying off middle management and supply people and warehouse people, and they're laying off a ton of people and going to a skeleton crew, that's a recession. And you often know recession because people that you know are getting laid off. That's when you know it's a recession. They say a recession is when your neighbor gets laid off, but a depression is when you get laid off. That's the scope of the economic environments. When you're decelerating, you've got a soft landing, recession, and a depression. Most people, most of these economic nerds think it's going to be a soft landing. There's still some debate here. There was a research paper, and I'll put a link to this here, by a bunch of economists that researched environments where there was high inflation and the Fed had to raise rates. They reviewed 16 episodes of this environment since 1950, when inflation was high and the central bank, like the Federal Reserve, they had to raise interest rates to fight inflation. So they reviewed 16 episodes since 1950 in the US, Canada, Germany, and the United Kingdom. In each of those cases, a recession happened. In each of the cases, just like the environment we're in today, where we had high inflation and the Federal Reserve had to come in, raise interest rates, slow the economy, it wasn't necessarily a soft landing. It was a recession. So does that concern you? Are you curious if I'm concerned about it? I mean, I am an expert in my own opinion, but I'll give you my opinion. I'm not concerned. I'm not concerned for several reasons. First of all, let's make sure that we distinguish between a recession and a stock market crash. I've said this so many times, but I have to make sure it's hitting us the right way. The stock market and the economy, which when we talk about a recession, we're not talking about the stock market. We're talking about the economy. We're talking about jobs generally. The stock market, they're connected, but they're also disconnected in a very material way. The stock market is like binoculars looking into the future. Whereas the economy, often we talk about a recession and depression, that's like a microscope looking at the here and now. If a recession is going to happen and all the nerds on Wall Street and all the smart people see that a recession is going to happen, the stock market will fall before a recession happens. And oftentimes, in the height of pessimism, at the very worst time in the recession, that's when that stock market climbs back up that wall of worry if it had gone down. Does that make sense? They're just different. And I want you to understand they're different. So the idea when I reference the stock market and will we see a stock market crash as a result of a recession, I don't really know. Again, I don't have that foresight necessarily, but it seems to me that the basic, what we call fundamentals of the economy, there's good jobs. There's the U.S. is healthy despite the debt. We've got a lot of cash on the sidelines. There's several different elements that lead me to believe that if there is a pullback as a result of an upcoming recession, that it wouldn't be deep and pronounced. So a recession, maybe. Deep and severe, that would cause a downward trajectory in the stock market. I think the probabilities are generally low that they will be a deep recession. Let's say there is a recession that's coming and you get the difference. You're like, okay, Daryl, I hear you. The stock market, it's going to go up and down. Okay, so I won't mess with my money. I'll leave that alone and weather that storm. Okay, good. You've got the right attitude. Hey, a recession's coming. Stock market will react to that before the recession hits. Just weather that. That's why diversification is a part of the plan. Just weather it, will be fine. Okay, you get that. But now let's talk about the economy, which is different than the stock market. I keep saying that, but talking about the economy, how do you prepare for a recession? Well, I think you have to look at it in light of your situation. So if you're retired or retiring and a recession's coming, I highly recommend that you revisit the pivoting process that I've talked about 1,000 times. And we have a pivoting ebook on the website, and there is a strategy for navigating through those volatile times because they always come. They're very predictable. You just don't know when, and you just don't know what the name of them, but they always come. And so we have in our pivoting strategy a specific approach to weathering storms. And as a high level, it's typically putting aside 1 year of cash reserves. But if you want to know why that's important and a few more details, again, there's an ebook on our website that's free. You can grab it, and it's pivoting your retirement or something like that. If you're currently employed and there's a recession coming, or you think that it's going to be deep, which again, I don't think it'll be deep. I think it'll be probably a soft landing or maybe a mild recession. If you're middle management, that's the position that usually gets cut first. So just know that and make sure your family has adequate reserves and pay attention to your industry and don't be naive. You don't have to freak out. But I do think that there's some industries that are more vulnerable than others and some companies that aren't in a good financial position. And so you just need to know those things and make sure that your family has adequate reserves so that you can make a transition into another career or another management job. But if you're middle management, watch out for that. I've already seen some signs in the marketplace that middle management is under stress, just so you know. And then finally, when we go back to those that are investing, just embrace the volatility. If anything, when it goes down and people freak out, when you feel a little poor and pessimism is at its height, hey, I'm not joking. You've been doing this a long time. You know this game. It's on sale. Talk with your advisor. You could shift a little bit more into equities or stocks, again, within your risk profile and all those things that are reasonable and practical. But just don't let emotions get the best of you, because what happens in these recession environments is Chicken Little comes out. And the Chicken Little, by the way, also sells gold. So just know that Chicken Little, who's on the radio and podcast and everywhere, Chicken Little typically sells gold, and they love to scare the heck out of you. And so you turn it off, just very gently turn it off. Talk with your advisors to say, look, I'm freaking out. As I understand it, this is the time to buy, or this is the time to maybe even shift a little bit more into equities or stocks. I think that's a healthy, mature conversation. I can't say every time, but if you go back historically, if we could kind of go back in time and talk to our past selves, we would have probably told our past selves, hey, instead of freaking out, you should probably buy now. And so if you've been through a lot of economic environments now, you do have the skills to navigate this next one. So again, I think that if we have anything coming around the corner, a soft landing is probably a likely scenario, maybe a mild recession, not too deep. I'm not freaking out. We diversify. We plan accordingly. We focus on what we can control. We turn off the noise and go on with our life. It's just part of the seasons of the economy. So I think that's the healthiest approach. I love this conversation because we're training our future self to respond to the environment that's coming around the corner. And that training is going to be so stinking helpful for you. So that way you don't react, because money stress, hear me out here, money stress weakens our decision-making. So thanks for tuning in today. I hope this was helpful and useful as we navigate this economy over the next 6 months, or 4 months now. We're in August, so we've got 4 months to the end of the year. A lot of uncertainty, a lot of unknowns, but Christmas will be here before you know it. Enjoy the time with your family, make memories, and remember, you think different when you think long-term. Have a great day.